Okay, day 6. Now we're going to look at strategies that allow you to keep borrowing if you get stuck, or if you want to work with other people, what can you do for property investing? So day 6, we're going to look at joint ventures, property trading, property flipping, and double settlements. The reason that a lot of people turn to these is because they've heard a no when it comes to borrowing more money, or like maybe their partner's not keen on buying another 1 mil investment property on their own and they want some more help. If you're running out of borrowing power, the key thing to remember is it doesn't mean you have to stop investing in property, it just means you need to be more creative and you need to understand different methods. So first one is joint venture, JV. Now usually this is going to be 2 to 3 people with different skill sets, and they're gonna split the profits, and there's more accountability when you're working in a group, and it can be more fun. It's like a game. You might have somebody that's quite handy, somebody who's got access to money, and then somebody that's good at finding properties. You might have 3 people that are all got money, and one of them's good at finding properties, or 2 people with money, one's good at finding properties. You've got to be creative here. So if you've got no money, you've got to be either handy or good at finding properties at the right price, and then you can find other partners to come in on that deal with you because the price is right. Splitting the profits, if you've got 2 people, then you might go 80-20 depending on who has put the money in. You might go 50-50. You can get creative on these terms. The key thing I like about joint ventures is the accountability. It can be a little bit more difficult getting finance, and that's where working with a mortgage advisor to get specialist mortgage lending is helpful. Now property trading it's a strategy where you get a property under contract, you might get early access, you might do a little bit of work, but generally speaking you're going to settle and own this property and you're going to sell it quickly at a profit. Let's say you see something advertised for 600,000, you think it's worth 650 after a little bit of work's done to it, and you buy it for 580. Now with $5,000 of home staging, $1,000 on landscaping, and maybe a few photos from different angles, you might be able to sell it for that 650 which you thought it was. Your cost of finance and staging and all the handy stuff is 20k, so you get a 50k profit. And basically property trading is arbitrage. It's spotting opportunities that other people don't see, or seeing value that other people don't see. And property trading is generally quite quick. You don't want to hold the property for long, you just want to get the deal done, book the profit and move on. Now if you're short on capital, property trading is something to look at more seriously. Now property flipping is similar to property trading, except you're going to do a lot more work. So if you haven't watched the Burr video, watch the Burr video. But generally speaking, you might be buying something that you think is worth, say, 750,000 after you've done a lot of work to it. You buy it for 600. You spend 100k on the reno, and you sell it for 750. So you're getting a $50,000 profit. But what you have to understand is the costs associated. You're going to have to pay tax, you're going to have to pay agents fees, there's going to be a whole bunch of holding costs. So property flipping, it's really important to understand those renovation costs. You've got to understand risk of tainting, risks of buying and renovating a property that doesn't actually come out more valuable at the other end. You've got to factor in your time, you've got to factor in the finance holding costs. If you get 6 months finance with a non-bank lender and you don't get everything done in 6 months, you have to roll your finance and pay finance fees again. So property flipping can be extremely lucrative, but you just need to understand that there's risk there too, and it does involve a sale. So generally, what actually a lot of real estate agents, they can do property flipping and they can get good deals on the sales of properties. Double settlement is wholesaling of properties. It's when you get something under contract, hopefully with a long enough settlement that you can find another buyer to come in and buy that contract off you, and you make a profit. So you see a lot of, this is a very high risk, high reward strategy. So you might see something advertised for $1 million, you get that property under contract for 980, and you put 6 months settlement and the vendor is happy with that. Now your job in the next 6 months is to find someone to pay you $1.50 or 1.1 mil, and you've got to advertise it in that period that another buyer is going to come in and take over that contract. And you've got to convince the agent and the vendor that you can settle on that property if you don't on sell it. And as soon as you go on with a plan, or if there's an understanding from the vendor or the agent that you're going to try and wholesale or flick this property on for a profit, then it might be hard for you to get that under contract. The thing when the market goes down, it is easier to get long contracts, and it's one of those strategies that if you had to make $1 million in the next 6 months, it would be a good, go and find a $10 million property for $9 million and try sell it for $11 million kind of thing. A lot of ex-bankrupts or current bankrupts end up, they are wholesalers, and sometimes they do extremely well and sometimes they don't. And if you read on National Business Review or Business Herald, and you'll see stories of even listed entities getting properties under contract for a long period of time and on selling them to some different construction company or some different investment vehicle, and often at a tidy profit. It's great when the market's going up. When the market's going down, if you have a long contract and you can't find another buyer, then you're going to have to settle on that property that you've gone unconditional on, potentially at a price that's lower than the valuation, and this is what causes the bankruptcies. So you really got to make sure that you understand your risks and obligations alongside the potential upside. And these are not all of the strategies for when you run out of borrowing power or you need more accountability, but there are plenty of successful investors in New Zealand that have dozens of properties, and they are doing joint ventures with friends or family. And even Blannon, my business partner, he has done a joint venture. I think it's property in Hawke's Bay. It was about 980,000, 50-50 with one of his friends and clients, and they split all the costs, split the rewards. There's just a bit more split risk and accountability, and split profit. So they both at the time were at a point where they couldn't go out and buy that $980,000 property on their own, but they could comfortably buy half. So it's good to consider these options, and there's definitely more if you run out of borrowing power. Let us know in the comments if you've got any questions.